Okay, hello everyone. So did you finish your breakfast? Are you there?
Yes, we're here.
Okay, thank you. So I injected caffeine into my blood. The Coke, not coffee. I already have coffee around 6 a.m. So okay. Um, okay, we just finished capital budgeting. So do you have any question to capital budgeting? Do you have any questions? If you do not have a question, I'm going to start to move on to the next chapter. There is a chapter 14, and then this is called real option. Real option. Before actually when I told last year, I included another chapter uh, defining more clearly what is the definition of cash flows to apply the capital budgeting. So anyway, I want to hit the kind of main point of some topic, and then I'll go to the real options. When you apply capital budgeting to cash flow, we should not evaluate every cash flow. We should not. We have to evaluate project-specific cash flows. And also, our target is incremental cash flow from the project. So in other words, there is a project A. We want to evaluate the impact of this project to the overall company's valuation. Then we do not look at cash flow relate to the project A. We do not. We simply focus on how much cash flow increased by project A. Do you follow me? Up to right now, we assume cash flow is a given. And then I told you before, cash flow is typically free cash flow. But if we look at more detail, that cash flow is an incremental cash flow. In other words, increased cash flow by a project. If you evaluate the project, you have to look at how much the project increase cash flow. That is what you have to look at it. But sometimes actually the people simply thought every cash flow related to the project should be considered. But it is not accurate. We have to look at how much cash change because of the project. So one of kind of a typical example is that I shared with you in the beginning of today's class. That is a saving from purchasing and in planning new machine. When people evaluate new machines profitabilities, in other words, project of replacing old machine by new machine, many guys actually mistakenly consider aggregate free cash flow of the company that replaced old machine by new machine. And then they said, oh, the project of a replacement is a positive. That is a typical errors. One more time. In that case, in other words, replacement project, then we have to look at which cash flow directly relate to the replacement. Replacing old machine by new machine directly associate with how much you are able to save money using new machine. There is a direct cash flow and incremental cash flows. So we have to look at how much company is able to save money by replacing old machine by new machine and using that one and also applying NPV IRR NPV IRR payback and discounted payback, any other criteria or budgeting tools, then we say this project is a good or bad. Again, what is a common mistake? Students say, oh, we have a replacement project, and then they consider every cash flow generated by the companies. So this is a common mistake, remember. So last year, actually, I included that chapter into our my lecture, but somehow the the second component of that chapter is not very helpful to students. So that is the reason why I dropped that in this class. But again, the key point of the chapter I did not include is when you apply capital budgeting, you have to know the specific cash flow associated with the project. And then you have to consider only those cash flow relate to the project specifically, not including everything. Okay, so there is a kind of a one of a key the learning of the chapter that I dropped. And then today we a little bit expand more about capital budgeting considering real options. What it means. Up to right now, actually, we believe project has a limited life, and then that's it. In other words, there's a beginning, there's an endings. But is it true? Answer is no, it may not be true. As we saw, economic life and physical life, managerial decisions can change lifespan of projects. Sometimes they want to stop in the middle of a period to maximize their free cash flow by selling machinery and project-related fixed assets. Other times, management want to continuously repeat the project until they have a positive net present value, because economic situation will change or size of scale increased. In other words, production size and scale increased, and then this size and scale issue start to reduce overall unit cost. And then as time goes on, company is able to save more money. In other words, compared to the first 3 years, if they start over again the other 4 years, at 4th year, they are able to improve cash flow. So companies, the management is able to expand operation instead of stop at the lifespan of the projects. There is another option. And also, the certain project will generate a lot of side product. It is not a side effect. Side effect means always negative, but actually however, flip side is additional or byproduct. So thus, those new products will generate new opportunity to sell to the market new product and new materials. So for example, around 10 or 20 years ago, actually, the US military defense system prepared the Star Wars plane. Right now, looks like in the middle of planning. The Star Wars plane was, they want to, US government actually want to shut down any nuclear missile to the mainland. But where they want to shut down? They want to shut down in the air and in the, what is the right word? Anyway, in the air. So anyway, before actually it reaching to the United States, actually it have to go to the penetrate the kind of the air area, so the ozone area, and then they had to penetrate and come back. So actually their plan was there was a plan to shut down when they flying those missile and airplane, anything come to the US, but it costed. Many analysts estimate how much it cost, because first of all, they have to newly develop weapon system. They also have to newly develop tracking system. They also have to set up the satellite system in the air and above Earth. And then those satellite systems make the net systems. So every satellite system has to watch what is going on. And then actually whenever there is a missile, anything's kind of coming to the US, they want to destroy in the air. But again, it costs, the many analysts say this project totally nonsense, too much expensive. But what happened? Those projects generate a lot of new technologies and new skill, and then another byproducts continuously. And then the other analysts say, no, Star Wars as it is, it might be not feasible. But however, it will promote a lot of R&D, research and development, and new material. It will generate new market. It will continuously maintain employment in the air defense or defense industry. So it has a lot of positive impact. So this is the part of the real options. So point is, up to right now, we just only think about one project, that's it. And then 3 years, 5 years, that's it. But it is not true. In the real world, management is able to expand those projects into the different area, or they are able to delay starting or terminations of timing. So it will kind of change cash flow and probability of certainties. So this is all about chapter 14. However, another information is recently the recent textbook did not emphasize this one a lot, because my understanding is, this is my understanding, I believe this one too much rely on uncertainty and probability distributions. So somehow textbook introduced but give a little bit less weight than before. That is how I sense it. But anyway, so today we will go for this growth real option. And remember, this one is going to be extension of a classic capital budgeting. Up to right now, we assume each project has a certain amount of cash flow and fixed lifespan. There was no variation. But in the real option, we want to change it. Can we change it? Yes, we can. Human being is able to change whole plan. And then when you change it, what will happen to the value of NPV and IRR? That is all about this chapter 14. Okay, and then actually sometimes students confused. Actually, oh, this is an option. Yes, this is an option. Why? Expand or changing project or not is an option to management. This is the reason why it is called real option. Later, we are able to apply Black-Scholes option pricing model. Even though there are lots of measurement issues, but we are able to apply. Okay. So anyway, let's go for chapter 14 topics. The real option, and then actually the decision trees, and then application of financial options to the real options. So let's go one by one. What is a real option? What is a real option? Real options exist when managers...
Professor, you are not sharing your screen.
Oh, I'm not. Oh, sorry. Oops. Yes. What happened to me actually? I don't know. Sorry. Today I woke up too early. Sorry, it's my fault. Anyway, yeah. So here, okay. So let's look at the topics in chapter real option, decision trees, and application of financial options to real world. So what is a real option? The real options exist when managers can influence the size and risk of a project's cash flows by taking different actions during the project life in response to changing market conditions. Again, this is a kind of repeating what I shared, what I said. So in the previous chapter, we believe everything was a fixed. Cash flow was a fixed, and then discount rate is a fixed. However, in realities, economic conditions and then cash flow is changing. So management or managers are able to adjust themselves by changing plan. So when they change plan, our capital budgeting also will change. So Arthur managers always managers always look for real option in projects. What it means, when project started, they want to always look at chance, how to improve the project. So when they try to improve performance of project, they change the plan or project operations. So when they engage it, this is an option. In other words, management is able to do it or they don't have to do it. They don't have to do it or they will do it. This is an option to the management. This is the meaning of a real option. Smarter managers try to create real options. Yes, if manager is smart, they want to see what is going on in the market. They want to adjust the plan. This is a real options. What is the single most important characteristics of an option? It does not obligate its owner to take any action. It really merely it merely just to give the owner the right to buy or sell asset. Again, management has an option, do it or not to do it. There is no obligation. So this is the reason why it's called option. How are real options different from financial options? Financial options have an underlying asset that's traded. We already covered this one in chapter 5 or 6. So here, financial option, when we discuss about option, there are call option and put option over underlying assets. What are underlying assets? Underlying asset could be stocks or bond or any other securities or investment opportunity, or it can be commodities such as gold, silver, cotton, pork, beef, silicone, and a lot of other materials could be underlying assets too. So anyway, financial option is written over underlying investment security or assets. And here, but real option has an underlying asset that is not a security in general projects. For example, a project or growth opportunity and it isn't traded. So basically, real option is not about trading contract. This is more about plan. Okay, but the point is that plan, who decide that plan to execute? Management. So to management, this change or revision or altering project is going to be option to them. So this is the reason why we call it real option. Real option is totally different from, not totally, but somehow different from financial options. So this slide is say the financial option is tradable, but real option is not tradable. Okay, how are real options different from financial options? The payoff for financial options are specified in the contract. Yes, we have an exercise price, we have a strike price. At the same time, on maturity, those exercise and strike price compared to the market price. So we are able to see how much payoff happen if we have this contract. But real options are found or created inside of projects. Their payoff can be varied. So depending on future circumstance, their payoff is going to be continuously changing. So real option is more uncertain compared to the financial options. So this is kind of a difference. what are some types of real option? So typically, actually, if you have a project, we always assume time zero is a starting point. But management have an option to delay projects. So, in other words, if there is a uncertainty right now, we are not sure really good or not. But after 1 year later, if there is a improved certainty, that certainty will have a more positive impact on company's operations. So this is the investment timing options. But keep in mind, delaying projects sometimes benefit companies by improving certainty. However, if you delay your project, what is the flip side problem? You will lose market and then you will be second participants to the market. What it means? First leader, first participating market, first participating and businessman and woman will be a leader in the industry and market. However, if we wait and then later join, we might have a hard time to improve our market shares. So this is kind of a something. I think, yeah, anyway, so this is kind of a pro and cons, but however, this is also option to the management. Jump on it or hold it. Look at what is going on, and then I want to pursue more safety, then actually you want to delay your investment. The other types is a growth options, expansion of existing product line. As I just shared of a Star Wars plan, even though actually it was tremendously expensive, really expensive, but however, the plan will generate a lot of byproduct in the employment. So at the same time, it will provide opportunity to expand existing technology and something else. So it's going to be provide another positive cash inflow. So growth option. So new product, I just explained it. So when they have like this way, suddenly I have the developing drinking project, drink, what should I say? Boba. I like the milk tea boba. So my project was developing milk tea boba. But suddenly in the kind of exploration, I found, oh, if I mix milk tea with the coffee, taste is much better. Then this one is going to be another option to options of first example. The second is going to be like this way. Oh, I developed the boba milk tea. Let's assume I developed it, and then actually the other guy say, oh, instead of milk tea, actually, why don't you sell fruit juice or something else? This totally new product. So anyway, or maybe the other your partner say, oh, let's change the shape of cups or straw or something else. So anyway, this is kind of options coming from the current project, but the options will give us extension of a product at the same time new product, and also this one also kind of give opportunity go to the another area, another market, and then actually it will give us the better opportunities to generate product. So again, the point was up to right now we just kind of static, in other words, fixed cash flow and limited time with the project. But in reality, project is continuously changing and evolving. At the same time, the project provide us opportunity of having new product, new market, and expanding our business. So this is a growth option. So if you are really smart and intellectual management and businessman and woman, you should not be happy with the one project. Think about how to expand the project to a lot of different directions. So this is kind of options. Types of real option. Also, there is abandoned options. flexibility options, and then sometimes actually we have to think about option of stop the project. People does not want to stop the project, they want to keep it continuously with their overconfidence. That overconfidence kill their profit, at the same time reduce a lot of growth opportunities. So somehow, if we consider this abandon option in the project, then actually it'll improve the company's profitability. Flexibility option is the same, similar. Actually, in other words, instead of staying with the one way as a manager, you can think of several different ways to handle it. Then actually it will improve company's profitabilities. 5 procedures for valuing real options. So first, discount cash flow analysis of expected cash flow, ignoring option. Qualitatively, assessment of a real options value, and then decision trees, and standard model for a corresponding financial option, and financial engineering techniques. So what it means? First, actually, if you have some project, you want to generate cash flow of the project annually. And then you start from there. At the same time, you explore whether this project has a chance of expanding or growing or something else. In other words, are you able to little bit adjust the project to generate additional value? So this is a real option. So in other words, qualitatively assess real option instead of quantitatively. Okay, so and then actually if you find something, then actually start to apply decision trees. So there is a project, and then you start to think about what is a possibility of revision and expansion. Then original cash flow will expand to the other cash flow reflecting different situations or circumstance. So we call it scenario management. Under different scenario, how the cash flow will happen. So depending on number of your scenarios, you have a different number of cash flow, and then this cash flow will compose your decision tree analysis. And then applying several standard models, and then you are able to estimate what is the value of embedded options. That is all about number 4 and 5. Okay, so let's look at the one by one. Analysis of a real option. There is a project. Initial cost is at $70 million. Cost of capital is at 10%. Risk-free rate is at 6%. Cash flow occurs for 3 years. Then, so here, so depending on demand, so it's high, average, and low. What is the probability of each demand status? 30%, 40%, 30%. And then annual cash flow will be $45, $30, $15, depending on level of demand. So, first approach, step, just to calculate discount cash flow analysis. So, as you can see here, we want to calculate expected cash flow. Why? Because we are dealing with the future. In reality, we are not sure how much we will have in the future. So in this case, we classify economic status or level status of demand in the future different category, assign probability to each different category, and then we calculate expected cash flow. 30%, $45, 40%, $30, 30%, $15. So 30% times 45 plus 40% times $30 plus 30% times 15. Then it will come up with this way. So expected cash flow is going to be $30. Present value of expected cash flow. What it means? Over time period, expected cash flow is this one. So this is 3 years. It's a 3 years project. So they simply assume expected cash flow 30, 30, 30. And also they assume cost of capital is 10%. Okay, so this is how they calculate present value of expected cash flow each year, discount every year, and then total present value is $74.61 million. So unit is a million. And then expected net present value. I'm sorry. Expected net present value equal to $74.60 minus $70. What this one? This one is the initial investment of $70. Subtract $70, and then you will have $4.61 million. So this is kind of a classic approach of calculating NPV with probability concept. So look, investment timing option. So here they start to kind of explore this project with several alternative options of revision. If we immediately proceed with the project, expected NPV is $4.61 million. However, if the project is very risky, then the project is very risky. If demand is high, NPV is going to be $41.91 million. High demand, but demand is low, net present value is a negative $32.71. So what it means? So here we have 3 status, am I right? Demand is high, and demand is average and low. So here, this is how they calculate 41.91%. 45%, demand is continuously high over 3 years. So this is a kind of a total present value of like this. Present value of 45, 45, 45. So discount one by one and add them together. Here, this formula. And then, so in other words, actually what they are trying to do is, this is the cash flow with a high demand. High demand. So 45, 1 plus 0.1, plus 45, 1 plus 0.1, power 2 plus 45, 1 plus 0.1, power 3 minus initial investment $70 million. This is how they calculate this one. So in this case, if demand is high, in other words, surely demand is high, we don't have to worry about probabilities, and NPV is going to be this one. But if demand is low, go back, what was the value for demand? $15. Then this one is going to be coming 15, 1 plus 0.1 plus 15, 1 plus 0.1 power 2 plus 15, 1 plus 0.1 power 3 minus 70. Then you will have a negative $32.70 million. So point is, okay, if you immediately, okay, anyway, so I'm going to explain later after looking at the second slide. Okay, here, if you wait 1 year, you will gain additional information regarding demand. If demand is low, you don't have to. You won't implant project. If we wait, the upfront cost and the cash flow will stay same, except they will be shifted year ahead. So what is the point? Let me go back. What they try to say is, depending on demand, this project will generate decent positive NPV or totally negative NPV. So as a manager, do you want to start now with the uncertainty, or do you want to wait? Do you want to delay the project by 1 year, and then you have a more better information about demand and then go for project? That is what this question is asking. Again, as I mentioned before, practically, if you delay your involvement or launching project, there is a risk you will lose. In other words, the market leadership will be taken by the another parties. So this is like a Tesla. This is kind of a risk. The Tesla actually invested a lot of money. So, but actually at the time, a lot of automaking companies, they thought electronic car, economically, it is not feasible. That was the reason why they did not involve a lot. Of course, they invest money, but they did not involve it because they are not sure whether this is really feasible or not. But as Tesla came up, and then as Tesla shared a lot of technology with the other auto company, the market situation is getting better. However, Tesla took over as a market leader in the electronic market right now. So many guys wonder how well other automaking company catch up Tesla. It sounds like not easy, but however, they will catch up eventually, but it's not easy. So I read a newspaper, the GM really put a lot of money, really a lot of money to generate electronic car. So other companies saying German Volkswagen, depending on pronunciation, it's Wagen or Wagen. So actually they also start to put a lot of money and they develop systems. So it is up to the kind of manager decision. But anyway, there is a pro and con about delaying the project. But in this case, in this example, the delaying will improve. Delaying will improve certainty, and then company is able to make the decisions whether they want to go for or not. So anyway, so here additional information, what it means. Improve certainty. Improve about knowledge. Improve knowledge about market conditions. High demand, average demand, or low demand. So procedure. Qualitatively assessment. The value of any real option increase if underlying project is very risky. If there is a long time before you must exercise the options. So what is the point? When the project involved in a lot of uncertainty over demand, and then that uncertainty will cause a lot of inaccuracy of cash flow measurements. So to the company, it's very risky because the company is not able to come up with the accurate profit measurements. So when project is very risky, that means the cash flow is uncertain. These kind of options, like delaying 1 year or 2 years, somehow has a lot of value. These decisions involving in delaying project has a lot of options, a lot of value. At the same time, actually, if there is a long time before you must exercise the option, that means if you have a lot of flexibilities and not chased by time, then still the option of your selection is valuable. That's what they try to say. The project is risky and has 1 year before we must decide. So the option to wait probably valuable. So what they try to show is like this way. First, you have to quantify cash flows and then estimate your expected cash flow. Yeah, and then actually after that on, you can think about what is what is the kind of benefit of exercising those options or engaging in those options. Analyze it. This is a qualitative assessment. And then you make decision. It's a whether it's a valuable or not using this decision tree. So procedure 3. Okay, first one, we understand investment character. What is a major problem? There is uncertainty about demand. So management start to realize it might be a good idea to take time to improve certainties. Then also they want to explore more how much time they have it. In other words, those any change really valuable to the company given time. And then they, in other words, qualitatively explore and assess is good or bad. That is what they have to do it. If they sense, okay, it's good, and then next step, we start to go for decision trees, considering probabilities. In other words, we want to confirm our decisions using probabilities. So here, if we delay, there is no change in our initial investment. Just everything is start from the time t equal 1. Can you see it? And then each situation is going to be 30%, 40%, 30%. But look at here. High demand, average demand, low demand. But somehow, after 1 year, we know if the demand is low, then we definitely will not go for it. So, with the additional information about market, if we sense demand is low, we will not go for it. What it means, we will not even invest money. So this side is totally 0. Instead of a negative, this is going to be end up with a 0. Okay, and then the other side stay there. So point is, by delaying 1 year, by sensing amount of demand, you can see this side more clearly. But if you start from here, you did not know. You do not know what is the level of demand. You did not even sense it. You don't sense it. So that is the reason why you have to swallow losses. But if we wait, we are able to sense probability of low demand, and then we will not go for project if we sense it. So discount the cash flow, discount the cost of a project at risk-free rate. Okay, anyway, so we have this one, and then let's see how we handle it. In this process, right now, everything starts from time t equal 1. What it means, you have to discount this cash flow back to here, everything, when you calculate it. So here, discount the cost of a project at a risk-free rate, since the cost is known. So in other words, other things are discounted by the cost of capital. However, initial cost is always the same. Honestly, personally, I do not agree. Honestly. But anyway, the author's point is, or assumption is, anyway, initial cost is going to be same, assumed to be same. So that is the reason why we have to apply risk-free rate. So that means this one simply adjust market conditions. So since the cost of known, the discount the operating cash flow at a cost of capital. One more time, initial investment will be discounted by risk-free rate because this is known numbers. But the other numbers are flexible. I should not say flexible. I'm going to say variable, changing. So reflecting companies and market other circumstance. So we have to discount this one by the cost of capital. So we have, for example, $35.70 million. This one is going to be, can you see it? So this one come from discount, this one twice, 1, 2, because time 2, twice. The other one, discount 3 times, 1, 2, 3. but our initial investment is going to be discounted by only risk-free, and then you can get an NPV over each scenario. Okay, so what is going to be your expected net present value if you wait? If you wait, then your expected net present value is going to be this way: 30% times this one plus 40% times this one, and then 30% times this one. So your expected NPV is going to be $11.42. So do you sense something? By waiting 1 year, your NPV is going to be reaching to $11.42. Before, how much was it? $4.61 million. $4.61 million. $4.61 million. But by waiting, your number is improved to 11.42%. This is an option, whether management wait or they want to pursue. However, again, practically, waiting sometimes means what? You are giving up chance to be a market leader. There is a big gap between market leader, follower, in terms of generating profit or revenue. Okay? We can see those cases again, Tesla, and the other one is which one? Amazon. Amazon spent a lot of money for first 3 years. When they spent money, people did not believe Amazon. They continuously said customers will come to store to see product. But Amazon invested, and then they became the market leader. And right now, they have to, the many competitors and policymakers really feel like Amazon is a really one of a big monopoly, and then they feel like we have to do something. Okay. So anyway, so actually the always pro and con side. So textbook simply say, oh, the delaying is a kind of a will give a value. No, no, no. What I want to say is this is a theory, but just the example. Okay. So just kind of this is one example. There is another example, opposite one also too, not in textbook. Maybe start earlier than anybody's. There is another option too. Okay, think about it. Decision tree with the option to wait, original discounted cash flow analysis. Decision tree, NPV is higher. So here, this one is a decision tree, this one is original one. In other words, option to wait is worth $11.42 million. If we implant project today, we gain $4.61 million, but lose the option worth over $11.42 million. You say lose the option worth $11.42 million. But anyway, we will look at furthermore this issue later. Okay, therefore we should wait and decide next year whether to implement project based on demand. Okay. Option to wait change risk. The cash flows are less risky under the option to wait, since we can avoid the low cost flows. Also, the cost to implant may not be risk-free. So this is what I mentioned about it. Given the change in risk, perhaps we should use a different rate to discount the cash flows, but finance theory don't tell us how to estimate right discount rate. So we normally do sensitivity analysis using a range of different rates. So point is when we apply certain discount rate, our application implies rate is going to be same every year. But what is the reality? Do you think rate is the same every year? Maybe not. This year, maybe market rate is going to be 7%. Next year, there's an inflation concern. So central bank will increase the rate. Then market rate will go more than 7 years. How about the other years? Maybe go more, stay with it. We are not sure. That is what they try to say. Really hard to calibrate what is going to be right discount rate to handle this real option valuation. So anyway, the next step, we would like to use financial options model to evaluate growth options. In other words, we approximate value of a real option using decision tree. What is a decision tree? Can you see it? This is a decision tree. But instead of decision tree, we directly apply financial options, Black-Scholes model directly. And then we want to come up with the value of growth options or real options. If the value of a real option is good and positive, we will definitely consider it. But however, the value of an option is not good and also worthless or is not worthwhile, then we will drop any real option. That is what they try to say. Here, procedure 4, the option to wait resembles a financial call option. Yes, similar to financial call option. We get to buy the project for 70 million in 1 year if value of a project in 1 year is greater than 70 million. This is like a call option with the exercise price of 70 million and expiration date of 1 year. So remember this one. So we are able to somehow apply financial option pricing model to the project, and then actually we are able to extract some numbers. That number represents value of real options. So here, buy the project is 70 million in 1 year if the value of project is greater than 70 million. So here, so 70 is so look at here. Can you remember Black-Scholes option pricing model? This is the Black-Scholes model. Exercise price is going to be cost to the implant the project. This risk-free is a risk-free rate. Time to maturity is so in other words, this is kind of they try to say 1 year project, 1 year option, not couple of years option reflecting actual lifespan of a project. So simply this is 1 year. And then P is going to be current stock price. This is the same as estimated estimated value of a project. So the following slide shows, and the variance. This is kind of one of a little bit headache because the option pricing model uses some variance, but this is not purely. It's not purely underlying securities variance. But we use it. We use underlying securities variance. But what is the project's variance? Does project up and down, up and down? Somehow we try to use the, which one? Cash flows variance. So this is kind of a next slide will show you continuously. Okay, so how about this way? Let me stop because actually if we go this one, actually this one continuously relate each other. So I'm a little bit kind of a wonder. It's a good idea to stop at the middle. Okay, so anyway, so today, let me see. Actually, Monday I'm gonna wrap up this one anyways. Actually, also we will have a presentation. So before we tackle the major measurement of a Black-Scholes model, let me stop here. So and then next class, actually, I'm gonna go for the other component. Okay?
Yes, it's okay.
Okay, so anyway, do you understand me what I explained today?
Yes.
Okay, thank
Yes,
you.
we do.
Oh, it's good. Was it not that challenging about real option? Is it good?
Yes,
If
it's
you
good.
Okay, thank you. But anyway, the point is like this way. This real option actually it's gonna be a little bit kind of a tricky, honestly. And then actually I think the how much practically it'll help us our decision making. I'm not sure, but somehow in the past, this real option was popular in corporate finance, but recently last kind of when I checked the other textbook recently, they tried to reduce the portion of this one. Of course they introduce it, but did not try to does not try to go very deeply. That is my understanding. Yes. Okay, so any other questions up to today's lecture? Do you have any questions?
Professor, actually, I have a question regarding the project. So,
Mhm.
we will do it and do it on Word or Excel or
Oh,
both.
yeah, this one actually the word actually you can the second project is gonna be, yeah, actually I'm expecting Word, second project. We have a three project. First project and the third project is Excel. Second and third is so the second and third project Excel, and then actually second project is a Word.
Okay, Professor. Thank you.
Okay, thank you. So yeah, you don't have to write a lot. Actually, I just want to see whether you are able to apply and then some play with those the questions. That is what am I looking for. Yes. And also, you guys already know how to use Excel spreadsheet. Am I right? So again, I'm asking you, you guys know already? Do you know how to use Excel to handle project? Am I right?
Yes,
Yes.
you are right.
Yeah, okay, thanks. Thank you, Antoine. Yeah, thank you for me. Yeah, anyway, the point was I just want to make sure everybody is able to handle Excel. Okay? Yes. Okay, so that is all about today's lecture. If you do not have any more questions. And then Dr. Hui, are you there? So Dr. Hui, are you there? Okay, so then actually do you have who are supposed to meet me today after class? How many students? Anybody has information? How many students who will see me today?
I think that would be group 5.
Group 5. Okay. So then actually you guys are welcome to leave, and then actually the group 5 stay here, and then I'll have a meeting with them. Okay. So anyway, thank you for hard working today. Have a good weekend. Take some breaks, and then I will see you on Monday. Okay.
Okay, see you then, Professor.
Okay. See you.
See you, Professor.
Thank you. Thank you for your hard working. Group number 5, stay here, and then the other students, please leave. Okay. Thank you. Okay. So only group number 5 stay here. So we will have a chatting. Okay, so let me see. Okay, so I'm gonna stop recording. So are you group number 5?